Taxes are one of the first financial realities most people encounter, usually arriving quietly in the form of a smaller than expected paycheck after a long month of work, where the difference between what you earned and what you received is carved up by federal income tax, state tax, Social Security, and Medicare, a routine transfer of money to institutions you rarely see but constantly fund. That moment of checking your bank balance and realizing hundreds of dollars are missing is often the first lesson in how deeply embedded taxation is in everyday life. This process is often framed as the price of living in an organized society. Taxes pay for roads you drive on, schools that educate future workers, safety regulations that keep food and water usable, emergency services that respond when things go wrong, and also for massive government expenditures that may feel abstract or distant. Different taxes target different behaviors, with income tax applied to what you earn, sales tax applied to what you spend, and capital gains tax applied to profits your investments generate, sometimes while you are doing nothing at all. On top of that, most workers contribute to Social Security and Medicare, systems designed to redistribute money across time and population groups, where Social Security functions like a mandatory retirement savings plan that pays out gradually later in life, while Medicare operates as a health insurance framework supporting older adults and people with serious medical conditions. Eventually, everyone faces the ritual of filing taxes, a process where the government already has most of the information it needs, but requires individuals to calculate and submit the numbers themselves, creating a system where accuracy is expected, mistakes are penalized, and compliance is enforced. Some people pay taxes continuously throughout the year through withholding or estimated payments. Others reconcile everything annually, and a small group avoid the process until legal consequences force the issue. Yet despite widespread frustration, countries with higher and efficiently managed tax systems often deliver stronger infrastructure, public services, and overall quality of life. Banks are another misunderstood pillar of modern finance, often imagined as giant vaults safeguarding piles of cash, when in reality they operate more like intermediaries that connect people who have excess money with people who want to borrow it. When you deposit money into a bank, most of it is not sitting idle behind locked doors. A large portion is loaned out to individuals and businesses under a system known as fractional reserve banking. This system functions because banks are only required to keep a fraction of deposits on hand, operating under the assumption that not everyone will demand all their money at the same time. Under normal conditions, this works smoothly, but during periods of panic or crisis, confidence can evaporate, withdrawals spike, and the system can strain or even fail, as seen during major financial downturns. Banks generate profit by lending deposited money at higher interest rates than they pay to savers, earning the difference as compensation for managing risk, liquidity, and infrastructure. In exchange, customers gain convenience through digital payments, transfers, and cards, safety compared to storing cash physically, and government-backed insurance that protects deposits up to a specified limit, reinforcing trust in the system. Interest is the mechanism that makes this entire financial structure function, acting as both the cost of borrowing and the reward for lending, essentially charging rent for the use of money over time. When you borrow money, interest represents the price you pay for immediate access to funds you do not yet have, and when you save or lend money, interest is the compensation for delaying your own use of those funds. Simple interest applies a straightforward calculation based only on the original amount, while compound interest continuously builds on itself, causing balances to grow or debts to escalate depending on which side of the transaction you are on. On consumer debt, compound interest can quietly transform small, manageable purchases into long-term financial burdens if payments are delayed or missed, while on investments, it accelerates growth, allowing gains to generate additional gains over long periods. This dual nature explains why interest can either destroy financial stability or create it, and why practical financial strategy focuses on eliminating high-interest debt quickly while allowing invested capital to compound uninterrupted. Inflation represents the slow, often unnoticed decline in purchasing power that explains why everyday items cost more over time, even though the numerical value of money appears unchanged. It does not arrive suddenly with dramatic signals, but instead gradually erodes what each dollar can buy, meaning the same income supports a lower standard of living as time passes. Inflation can occur when demand outpaces supply, when production and transportation costs rise, or when collective expectations drive people to spend sooner rather than later, creating a self-reinforcing cycle of price increases. A modest and predictable level of inflation is generally considered healthy for economic stability, encouraging spending and investment, but rapid or uncontrolled inflation damages savings, lags wages, and undermines trust in currency. To counter this, governments and central banks often raise interest rates, making borrowing more expensive and reducing overall spending, which cools economic activity but can also slow growth. When economic pressure intensifies, economies can enter recessions, periods defined by sustained declines in economic output, reduced consumer spending, rising unemployment, and declining business investment. Recessions can be triggered by high interest rates, global conflicts, pandemics, financial crises, or simply the natural progression of economic cycles moving from expansion to contraction. During these periods, companies cut costs, households prioritize necessities, and uncertainty dominates decision-making. Governments attempt to soften recessions through policy responses such as lowering interest rates, providing stimulus payments, or increasing public spending, aiming to restore confidence and encourage activity. While recoveries eventually follow, recessions often leave long-lasting effects on employment, wealth distribution, and business stability. Credit scores operate quietly within this broader system, acting as numerical reputations that measure reliability rather than wealth. These three-digit numbers influence access to loans, interest rates, housing, and even employment opportunities, shaping financial outcomes in significant ways. Credit scores are calculated using factors such as payment history, credit utilization, length of credit history, types of credit used, and recent applications, with timely payments and low balances carrying the most weight. Maintaining a strong credit score requires consistency and discipline, as missed payments and high utilization can quickly cause damage, while responsible behavior over time steadily improves it. Paradoxically, having no credit history at all can be just as limiting as having poor credit, reinforcing the idea that participation in the system is often required to benefit from it. Currency itself underpins all of these systems and exists not because it has inherent physical value, but because society collectively agrees to treat it as valuable. Money simplifies trade, enables specialization, and allows large, complex economies to function by acting as a shared medium of exchange and store of value. Governments issue currency, central banks regulate supply, and everyday transactions reinforce its legitimacy through use. Managing the supply of money is critical because printing too much leads to inflation and erodes trust, while restricting supply too severely can limit economic activity and access to basic necessities. In this sense, money is a social construct maintained through shared belief, regulation, and consistent use. Investing offers individuals a way to protect and grow their wealth within this framework, allowing money to work independently of time spent laboring. Instead of trading hours directly for income, investing shifts the focus toward allocating capital and assets expected to generate returns over time. Common investment options include stocks, which represent ownership in companies, bonds, which function as loans to governments or corporations, funds which bundle multiple assets to reduce risk, and real estate, which generates income through use and appreciation. All investing involves risk, as markets fluctuate and outcomes are uncertain, but long-term participation, diversification, and patience historically improve results. The greatest risk often lies not in market volatility, but in failing to invest at all, allowing inflation to erode purchasing power year after year. Value connects every part of the financial system and exists not as an objective measurement, but as a shared perception that determines what people are willing to pay. Scarcity, usefulness, branding, and emotional appeal all influence perceived value, explaining why similar products can command vastly different prices. Individuals and businesses that create or control highly valued goods, services, or skills are rewarded with higher income because others are willing to exchange more money for what they offer. Understanding value creation allows people to align their efforts with demand, increasing earning potential regardless of the field. Time is ultimately the most powerful force in finance because wealth accumulates gradually through consistent behavior rather than sudden breakthroughs. Most people exchange time directly for money, limiting income to hours worked, while those who build systems, skills, or investments allow time itself to generate returns. In investing, time amplifies compound growth, turning small, regular contributions into substantial sums over decades. This is how individuals with ordinary incomes can achieve financial security, not by beating the system, but by participating in it long enough for time to do the heavy lifting. What makes these concepts difficult is not their complexity individually, but how they interact with one another over an entire lifetime. Taxes reduce immediate income but fund systems that stabilize economies. Banks move money efficiently but rely heavily on trust. Interest quietly compounds outcomes for better or worse. Depending on decisions made years earlier, inflation punishes inaction and rewards planning, and recessions test resilience and expose weaknesses. Credit scores incentivize certain behaviors. Currency depends on belief. Investing demands patience, and value constantly shifts as society evolves. Over time, individuals who understand these relationships gain leverage not through shortcuts, but through alignment with how the system already works, proving that small, informed decisions, repeated consistently, matter more than income or luck. Seen this way, money is less about numbers on a screen and more about how resources move through time, and those who understand this movement reduce stress, make clearer decisions, and steadily improve their financial position.